Hello, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm excited to launch this presentation today. And I promise to always keep these presentations different and teach you new concepts and techniques each time. And I'm going to start out with some of the basics just to make sure we're all on the same page and understand the essentials of Forex and Futures, and then we're going to go on. I want to teach you a new technique that some of you may not be aware of, but is extremely powerful, and I use it in my own trading and analyses. So today's presentation is called How to Spot Big Upcoming Moves in Forex and Futures. I'm going to show you to do exactly that. I think you'll be impressed. So first I want to discuss the quick risk disclaimer. The idea here is that there's a very high degree of risk involved with trading. As you know, Cyber Trading University and myself are not recommending any exact trading moves or investment advice or telling you to trade. So you can read through really quickly. You pretty much understand the drill. But this presentation is for educational purposes only. All right. So want to briefly discuss my background. My name is Jesse Colombo, and I'm an independent economic analyst and researcher. And I first became known around 2008 because I was recognized by the London Times for predicting the financial crisis. And I started warning about it as a university student in early 2004. And I built a popular website called stockmarketcrash.net where I warned about it. And this became one of the most highly trafficked websites on this topic. And it was in the LA Times in 2005 when I was 19 years old, because it was one of the four most highly trafficked sites on it. When it all blew up, that's when I became recognized. And I became much more well known in recent years because I started noticing all these new economic bubbles developing around the world, outside of the U.S. and some within the United States. And I started warning about it via social media and built up a very large following. And then Forbes contacted me, Forbes magazine, asking if I'd like to write a column for Forbes.com, which I've been doing for the last year and a half, and it's been quite popular. So I discuss economic bubbles that are developing around the world, but also the trading implications of these bubbles and how various Forex or currency trends as well as futures relate to these bubbles and different strategies for trading them. So these topics are quite interrelated and they integrate very well. And I recently partnered with Cyber Trading University to teach Forex and futures webinars and classes, and so far it's been going great, and I've been enjoying it, and so have many of the students. So just want to give a brief background on Forex for those of you who are not familiar with it. Forex is just a term that's used to describe the international interbank currency market and also the speculative trading of these currencies. It's not a word that most people off the street are familiar with, yet is one of the most important markets to be aware of, and it actually dwarfs the trading volume of other markets that are most people are more familiar with, ironically. And Forex is a decentralized market, unlike the stock market or futures market, because there's no single exchange where it's traded. It's not traded on the New York Stock Exchange or American Stock Exchange. Basically, it's traded among banks via electronic networks. Banks will trade one versus another. It'll be Goldman Sachs trading with JP Morgan through their dealing desks, and that's where the majority of Forex trading volume occurs. But there are also retail Forex traders, like many of you, or if you're interested in trading them, who trade from home, and it's a much smaller percentage of the market, but it's the same market that you're swimming in the same market as these big fish of like Goldman Sachs and JP Morgan hedge funds. And there are certain techniques that you can use, which I'll discuss, where you yourself can gain an edge in this market. And Forex is the most actively traded financial market in the world, even though most people are not familiar with it. It trades over $5 trillion worth every day. And it's that very high liquidity or trading volume that is so beneficial for traders, as I'll discuss in coming slides. So the general gist behind Forex and Forex trading is that currency exchange rates can be charted and traded just like a stock or just like a bond. And I'm showing this example of the euro versus the US dollar. So even though many people are familiar with trading currencies, let's say if they take a trip to Europe and they'll trade their dollars for euros and vice versa when they come back, you can actually speculate on these exchange rate differences because they're fluctuating up and down just like a stock would. So in this example, I'm showing this chart of the euro versus the US dollar, and at the time when I made this slide just a few weeks ago, the euro was worth $1.10, just 1.1073 US dollars. It just means that for every 1 euro, it's going to cost 1.1073 US dollars to buy it. It's a little bit weaker since then. It fell quite a bit earlier this month, and then now it's recovered somewhat. So there are many famous Forex traders who basically built their fortunes around Forex trading, even though the common man is much more familiar with trading stocks or bonds. But the smart money trades Forex. So here's some examples of famous Forex traders. The most notable of them all is the infamous hedge fund manager George Soros. And he first really became known as a Forex trader after breaking the Bank of England on Black Wednesday on September 16th, 1992. And basically what he did was through his trading, through his influence, he forced Britain to leave the European Exchange Rate Mechanism, or ERM, and that was the precursor to the euro. And it was basically an organization, a loose organization of European currencies where they agreed to keep their currencies at a certain rate to keep their policies in sync. And he was betting that Britain was going to leave this, and that the pound was going to crash when it does. It was going to weaken significantly. And he put his money where his mouth was via his hedge fund. And within a few days, he made around $1 billion as it crashed. And that's one of the beauties of Forex, is that it allows you to trade big money because it is so liquid. You're not able to move the Forex market as much as you could with a stock. And a lot of traders in the cyber group have experienced this, especially some of the larger traders like Rich or Fausto, Brett, have actually experienced themselves moving these stocks as they get in and out. Whereas the Forex market, because it is so much more liquid and so much of a larger market, you're not going to move these currencies or this market, which allows you to get better fills. You can move in and out very quickly. It's all traded electronically. And there's just so many buyers and sellers at any given point that you should have no problem. Let's say if you want to sell and exit your trade very quickly, you're not going to get so much of an adverse price. If you want to get out or you want to get in very quickly, you can do that instantaneously. So another big money trader, Bill Lipschutz, he made $300 million in 1 year via Forex. And yet another trader back in 1987 made $300 million just by betting against the New Zealand dollar alone. So there's incredible potential within this market. It's one of the most exciting markets in my mind. And now I want to discuss futures, and then I'm going to eventually bring this all together and discuss the relationship between Forex and futures because they're so closely related. Many people tend to think of these individual financial markets as completely different entities, yet in my mind, because of globalization, because of electronic trading, everything is correlated now. Everything's tied together, so there's no clear delineation between the futures market or the Forex market and so on and so forth. And there are even futures on Forex. So there's a lot of overlap now. Anyway, the idea here is that futures are derivatives contracts that allow you or traders to profit or insure against movements in various markets, everything from commodities such as oil and wheat to stock market indices like the Dow and S&P 500, or even on currency exchange rates like that euro example I showed you. There's many different ways to skin a cat in the world of Forex. You can trade Forex, or you can bet on currency fluctuations via the futures market. You can even trade options on Forex, or even options on Forex futures. Not to complicate things, I don't want to intimidate you, but just giving you an idea of how deep this market is and how many financial products are out there on these different markets. So one example of how futures are used, and in this example, these particular traders are not speculators. They don't really care about trying to make money in it. And it's in this example, it's farmers. Let's say a wheat farmer in the heartland of the United States who uses wheat futures to lock in the value of their wheat harvest. They have a lot of capital or wealth essentially tied up in the value of wheat. And if wheat prices go up, that's good for them because they receive more revenues when they go to the market and finally sell after the harvest. On the other hand, if they expect, let's say they're going to receive $10 million worth of wheat revenues from selling, and let's say the wheat prices fell significantly and they only receive $5 million, they could stand to lose quite a bit of money because they have to lay out all these expenses ahead of time, and if they can't predict what wheat futures or wheat prices will do, they stand to lose money. So what they do is they use the wheat futures market to lock in the value of their wheat harvest. And what they'll do is they'll short wheat futures. They'll basically enter into a bet where if wheat prices drop, they will get compensated via the futures market. Example number 2 is, let's say if a speculator expects wheat prices are going to rise, they simply go long or buy wheat futures just like you would buy a stock. You think stock prices are going to rise. You can do the same thing with wheat and oil or treasury bond futures. And futures prices, along with Forex or currencies, can be charted and analyzed using technical analysis just like stocks and bonds and pretty much all traded assets. So here's just a basic example of crude oil futures charted. You can see on the y-axis, that's just the price of dollars per barrel. This is West Texas Intermediate crude oil. And you can see it just fluctuates up and down just like a stock or bond would. No differently. You can buy and sell, or you can bet on prices dropping. And funny enough, I warned about this crash. You can see crude oil crash from around $105 per barrel all the way down to in the 40s where it is right now. And I warned about this back in June, publicly on a large scale. Warned over almost 270,000 people via my column. So the idea is there are ways to forecast or predict these markets and to start placing bets on them. Whether it's to the upside or to the downside. If you think prices are going to drop, you can short. If you think prices are going to rise, you can just go long. So I know this may seem basic for some of you, but I'll be going into some more complicated concepts very shortly. Just want to make sure we're all on the same page. Here's another example of corn futures. You can see fluctuates up and down just like a stock would, just like oil in the other example would, just like the euro versus US dollar exchange rate does. And in this case, the scale that's used is basically cents per bushel. So you can see it's 388 cents per bushel, or basically $3.88 for every bushel of corn. And it moves up and down. And if you think corn prices, let's say if you think the corn crop's going to get devastated, you can bet accordingly. Here's another one, live cattle. This is basically meat prices. This affects the price of everything from all sorts of meat that you buy. You go to McDonald's, you go to the supermarket. Well, these are wholesale prices for live cattle. It's not processed meat, but rather actual live cattle before the slaughter. And you can see prices have been soaring. Right on the y-axis, it's measured in cents per pound. So at the time of this chart, it was $1.54 per pound of live cattle. They basically weigh the cows. They're hundreds of pounds, if not over 1,000 pounds. You can also see bond futures. You can see there are so many diverse markets. You would never think that bonds have anything to do with cattle or have anything to do with oil. Yet these are all futures contracts. So this is the 10-year U.S. government note. You can invest in 10-year U.S. government bonds, or if you're not interested in investing in the bonds themselves, you can trade futures on them, which is a derivative on their price. And you can bet that it's going to go down and make money, or you can bet that it's going to go up. And here's the example of currency futures. So I showed that euro versus US dollar exchange rate before. But another way of going about it to speculate on currencies is using currency futures. So in this example, I'm showing the US dollar index, and I use this quite a bit in my currency analyses. So this is not a currency itself. You're not going to go to Europe and exchange the US dollar index for euros. But what this is essentially it's like the equivalent of the Dow or the S&P 500, but for the US dollar. And what it does is it measures the strength of the US dollar versus its major trading partners. So major currencies like the euro or the yen have a very high weighting in this index. And what it does is it's a proxy for the strength of the US dollar. So instead of looking at one currency pair, like how strong is the dollar versus the euro, what it does is it measures it against all the major currencies. And when it's rising, it means that the US dollar is strengthening against other currencies, and vice versa. So if you think the dollar is going to crash or fall or go into a bear market, you can bet against it. Or if you think the US dollar is going to soar like it did for the last 8-9 months, you simply go long on the US dollar index futures. So currencies and futures have a lot in common. So many common denominators. So the main factor behind it is that both currencies and futures, like stocks and bonds, are driven by the psychology of market participants. And because of that fact, technical analysis or price pattern analysis works very well in all these different markets. It's really the same people behind it. Many times it's the same hedge funds that are trading all these different markets at once. So you could have the same analysts or same economists or same hedge fund managers who 1 minute is placing an order in oil futures, next minute's going long the euro, and the next minute's trading a stock index future and then individual stocks. So that's part of the reason why all these markets are so tied together. And a skilled technical analyst or a chart analyst can look at the charts of any market without knowing what the market is. You don't even need to see the name of that market. But they can use these same principles that I'm going to discuss to trade and forecast moves in it. So you can show me a chart of live cattle, but not tell me what it is. And you can do the same thing with oil. I don't even have to know what it is. And I can look at it and spot common patterns that all these markets start to display. So just going to discuss basic technical principles, and then I'm going to go into some more advanced techniques that may blow your mind. But you'd be surprised, even though some of these techniques I'm going to discuss I think they're simple, and I don't want to insult your intelligence, but you'd be surprised how few very sophisticated financial market participants are not even aware of these. Like, I'm talking about PhD economists from Harvard. I'm not even exaggerating when I say this, are completely unaware of the most elementary technical principles like support, resistance, trend lines, etc. And it just boggles my mind. I really think it's a form of intellectual snobbery how, for them, if it's not an advanced differential equation, they completely write it off, even though it works. You know, it's like, why would you throw out any type of system that can increase your odds? And yet they do. And so because of that, it's no surprise that our financial system and economy is in such disarray and shambles. So we need a lot of reform. So different topic for a different day. But anyway, so here's the first basic technical principle is support. The idea here is that markets tend to typically fall back to common levels, key levels that you'll see on a chart. And they'll usually be a major round number or a number that has psychological significance for many participants, market participants. So in this example, I'm showing you copper, and you can see that $3 per pound support level. You can see that horizontal line that I drew, and that is held for years. It's really a half decade, where starting in 2010, once copper rose above that $3 per pound support, it kept on coming back down to that level several times and bounced over and over and over and over. And the reason why that often happens is because when you have a memorable number, like, oh, $3 per pound, it's very easy to remember. It's a good benchmark, basically. What happens is traders put their orders at those levels. So they say, if copper drops to $3, I'm going to sell or I'm going to buy. Also, because journalists, people who write for Business Insider, Wall Street Journal, Reuters, Forbes, etc., are more likely to write article headlines or write articles when markets cross above or below notable levels. They're not going to write about copper if it's going to cross below $2.85, but if it drops below $3, for example, that may be considered newsworthy. And I know, because I'm in this business, I'm telling you this based on experience, that headlines are more likely to be written when there's an important, memorable number. So anyway, that generates interest when you see something coming out in the Reuters news wires. It says copper falls below $3 per pound. Now all of a sudden, all eyes are on copper, and that generates interest. So that's what creates these key support and resistance levels. And also you have trading algorithms or computer programs that are designed to actually look for major areas of support and resistance and then buy and sell accordingly. And then you'll see trading programs will kick in when a threshold like this is crossed above or below. So you can see copper kept on bouncing, so it could have been an opportunity for traders to buy when it hit 3 and you get a little bit of a bounce. In this case, it's a 33% bounce from $3 per pound to $4. You saw the same thing here in mid-2013. You got a 50-cent bounce. It's quite worth it if you're trading futures. That can add up to a pretty penny. Pardon me. And you can see there have been a few times where copper tried to break below, wasn't able to do it, and then bounced right off. And that was at $3 per pound. Once the support, or basically think of it as a floor, once that was broken, that was a sign that the trend has changed dramatically, that this is a major technical breakdown. So this is what happened in late 2014. You had the strengthening U.S. dollar, which punished commodities because commodities do not like a strong dollar. They trade inversely. That's a major principle I've discussed in prior webinars. So once copper broke below, that was essentially a sell signal. Once there was a solid, convincing close below that level, that was a sign that there was likely to be further momentum to the downside. So that's the principle of support. Resistance is basically just the inverse, really just the flip side, where you'll see a market. In this case, I'm showing Japanese yen. And you can see Japanese yen, copper, what do they have in common? Well, quite a bit, because they act the same way. You can see it kept on hitting that same level. It was think of it, a resistance level as a ceiling. It kept on bumping its head, bumping its head, bumping its head for quite a bit of time. What is this, a good 7-8 months or so? Where every time it was unable to break, it was an opportunity to sell or short. Basically bet that the yen was going to weaken against the US dollar. And then once it was finally unable to break above there, it's no surprise that that was a sign that there was going to be a big weakening. That's what happened. We saw this last summer. And then a new resistance formed starting in December for the last 3-4 months at 0.86 to the US dollar. You can see it kept on bumping its head at 0.86. And opportunities to sell every time it was unable to break above. So now I'm just integrating the two. You can see this is gold, a completely different asset from the other ones I showed. Support, resistance. You can see it was trading in a range for 2 years. It's still actually pretty much around that same range. Where gold, after falling in late 2012 and early 2013, kept on bouncing around between $1,200 an ounce and $1,400 an ounce. Just up, down, up, down, up, down. And you could see, once again, key memorable level. A level that's likely to drive news headlines, kick in trading algorithms, and where traders are likely to put their stop loss orders, limit orders, etc. And you can see every time it dropped to 1,200, you could buy. Every time it bumped its head on 1,400, you may want to consider selling. And range-bound trading like this can be quite successful. I know my esteemed colleague Rich trades in Cyber Group all day long intraday on these trading ranges and does very well with it. He just trades stocks on intraday, even if it's on a 20-minute time frame. So it's the same principle whether you're looking at 20 minutes or 2 years, as you're seeing right here in gold. The other principle, and this is basically similar to a support level, except it's on a diagonal. But it's the same concept. This is a trend line. In this case, this is an uptrend line on the US dollar index that I discussed earlier. And you can see keeps on hitting that line and bouncing, bouncing, bouncing. And I'm not just showing this in hindsight because I was following this since this trend line started last summer, and I've been showing these levels publicly, showing that there was likely to be a bounce when the US dollar index hits that level. And I was watching. I wasn't saying it was going to bounce or it was going to break below. I was just saying, watch this. It's worth watching because it's likely to be a turning point. And so far, it's bounced several times. Pardon me. And basically, when you see a market or a currency, etc., above a level like this, it means that there's a floor underneath it. And that's a sign that the market's in a confirmed uptrend. And in general, you want to trade with the trend. You don't want to trade against it. You don't want to be a salmon that's swimming upstream. You want to take the path of least resistance and trade with the trend because it's biased to the upside in this case, and the gains are going to be much greater on the upside versus betting against it. So here's the opposite. This is now the British pound, completely different currency and market, same principle. This is a downtrend line. Just think of it as a resistance level or a ceiling that's on a diagonal. It's a downtrend line. And you can see every time the pound touched it, it sold off. And you could have shorted each time it hit. And then once it finally breaks above, that's a sign that the trend has changed. It doesn't necessarily mean that it's going to start soaring from there, but it means that the worst is usually over, at least for that phase of the downtrend. Again, basic principles. I'm not going to bore you. I'm going to go into something more complicated shortly, but if you know these, you know more than most Harvard PhDs in economics because they're just too snobbish to even learn this. It's like they put the blinders on. They just cover their ears. They say, no, I don't want to learn this. Why? Why wouldn't you want to learn something this is how the markets trade? Why would you turn away any possible valuable information? But yet that's what they do. And that's the world we're living in. It just boggles my mind. So I'm now integrating further. You can see this is the Japanese yen. And I showed you that resistance level earlier. And it turns out there was a support level right underneath 1 year ago. Really, this is back in 2014, a year ago. And you can see the yen was in that range. It was just bouncing up and down, just like gold was for the last. And gold is between 1,200 and 1,400. Well, the yen is doing this, or was doing the same thing. And once the yen broke down in late August 2014, that was a sign of a major technical breakdown. And that foreshadowed this big move from 0.96 all the way down to 0.82. It really is as simple as that. Just being aware of key levels that give you an advantage. And you could have shorted right over here and made quite a bit of trading profits just by shorting when a trading range leads to a breakdown. Here's the other technical principle of consolidation. So in this case, I'm taking the trading range concept a bit further. And basically, it's a consolidation. So the idea here is, let's say, I'm going to use an example of a runner. Let's say they're sprinting. And then they stop to pause to catch their breath. And then they keep on sprinting on in the same direction. Markets do the same thing. It's humans that are trading markets. And human traders and investors take pauses. They want to reevaluate the information. They want to see if the news is still coming in the same way as it was when the market was trending. And if it does, it'll continue on again. It's like starting up, sprinting again. So in this case, this is the Australian dollar. Again, completely different market from the others we've been looking at. So you can see For much of spring and summer 2014, the Australian dollar was just bouncing around in this trading range between 0.92 and 0.94 against the US dollar. Once it broke down, just like similar to how the Japanese yen broke down, that was a sell confirmation in early September. You could have shorted right then and there. And then a consolidation formed, another one basically, another trading range formed in October and November, bounced up and down between 0.86 and 0.88. Basically, that's where the sprinter is catching their breath. And most often, these consolidations break out or break down in the same direction as the trend led into the consolidation. So in this case, the prior trend was down. You can see in September, there was a downtrend. Then it consolidated in October, November 2014. And then without even knowing which way it was going to break, just by probability alone, knowing which way the prior trend was, you had a good idea that there was going to be another downtrend, and that's exactly what happened once it finally broke below the lower bound of this range, or the support level at 0.86. Broke down again, declined in late November, early December, and then formed another consolidation between 0.82 and 0.80, and then did it again in January. And it just keeps doing this over and over and over, and you'll see these markets will rally or they'll fall, and they'll form one consolidation after another, after another, after another. And it gives you plenty of opportunities to jump on the trend. It's a simple concept, but few people are aware. So I discussed consolidations. There are other types of consolidation patterns. Not all of them will be those two horizontal parallel lines that I just showed you. Sometimes there'll be other shapes, like you'll see, in this case, this example is the US dollar index, and it formed what's known as pennant patterns. These look like small triangles, literally a triangle shape that you'll see on the chart, where you can see the downtrend line, really just a resistance line overhead, and the uptrend line, which is really a support line, will converge together and form a triangle. And you'll see that type of consolidation happen before a big move. Sometimes I call them, if any of you followed me in the cyber group room, I spot these patterns, and so does Rich all the time, by the way. Spot these consolidation patterns all day long, and I sometimes I call them squeezes. And when I get to the more advanced topic toward the end of this presentation, I'm going to explain to you why I call them squeezes. Sometimes people get a little confused, but I'm going to explain the background behind that terminology, and it'll make complete sense. So you'll see basically the lines will squeeze together, where at the beginning of this pennant triangle pattern, you'll see volatility, where the market or currency in question is basically chopping up and down in a wider range, and then eventually it quiets down. And that's usually the calm before the storm. This will usually happen before a major news release that tends to affect the currency market, or a major market meeting, or let's say a central bank meeting, like a Fed meeting like we saw last Wednesday that led to the big Forex move, or an ECB, European Central Bank meeting, or a Bank of Japan meeting, or a major U.S. economic number. And then all of a sudden, that's the cue that the currency or the asset in question is about to break out. And once it finally breaks out, it tends to keep running in the same direction as the prior trend. So you can see these are pennant patterns. I called them out to my social media followers as they were happening before they broke out. And the prior trend that led up to them was up. So it's no surprise that once they finally broke out of those patterns that they continued to run. And you'll see these all the time. If you train your brain to look for these little triangles or pennants, you'll see them all the time. You'll see them in intraday stocks if you're in the cyber group. And that's usually a sign that there's about to be a big move. And of course, as it relates to cyber group stocks, you want to have the orders confirming, the level 2 total view. You want to have confirmation confirming these moves. So everything I do in the markets must have, in my mind, I always believe in having confirmation, where you have multiple indicators, multiple signals, and multiple correlated markets confirming one another. because it reduces the probability of there being a false move, or a head fake as it's sometimes called. Here are bearish pennant patterns on the way down. In this case, this is crude oil. This is another one I showed publicly as it was happening. You can see in early December, crude oil fell after OPEC said that they were not going to cut oil production as many market traders were expecting. And you can see late November it fell, I think it was about $10 per barrel. And at this point, many traders were looking for a bottom. It was like, I think it was around $67 per barrel, and traders said, this is it. This is the bottom. It fell from 105 all the way down to 67. It's time to go long. When I saw that pattern, I said, uh-oh, that could be a very bad sign. If you're long, that is. In my case, I was warning about it. I was considered publicly bearish, so it just benefited me. I mean, it didn't affect me. But when I saw that, I said, if this is a pennant and this does break to the downside, these declines are only beginning. And that's exactly what happened. And then it did it again, unbelievably, just weeks later in late December. And then broke down and fell from the high 50s down to the mid 40s. I think it was around a $12 move. And you could have shorted every time you saw these pennants form, and then an actual confirmation in the form of a breakdown from the pattern. And you can see the prior trend that led into it was down. And that's the way it broke out. And mind you, it's not always going to be a continuation pattern. A minority of these will be reversal patterns, where sometimes you'll see a pennant form after a downtrend, and sometimes it breaks to the upside. But that's not a reason to worry or fret, because you're waiting for confirmation. So if the confirmation is to the upside instead of the downside, big deal. So you take a long trade. You know, it's not about predicting markets. You want to be reacting to markets, not saying here's what it's going to do in advance. That's how I trade. So another important pattern to be aware of, it's another consolidation pattern, is a wedge pattern. And it has similar implications to those pennants, which are really just short-term triangles. In this case, it's a longer-term triangle that forms over a longer period. This is the New Zealand dollar. And you can see this past fall, the New Zealand dollar had a sharp decline from July until late September. Then it bounced around between a major support level at 0.76 and right underneath a major resistance level, which was a downward sloping resistance level, or a downtrend line, but a resistance level nonetheless. Bounced around, bounced around, bounced around. You could have, if you were that type of trader, so inclined, you could have traded and gone long every time it hit the lower bounds, and then sold it when it hit the top, and shorted on the way down, and went on the way up, down, and so on and so forth. Once it finally broke below that key level, 0.76, that was a sign of a further breakdown. So you could have caught this move. And sometimes you'll see return back to prior levels, but the idea is if you get in here and you short at 0.76 and ride it all the way down to 0.72, you can use a trailing stop loss and keep on moving it down, and then once it finally rallies, you get out. And you capture basically the meat or the center of this profit right over here, and it would be a significant, worthwhile trade. All right, so now we're going to get into something a little more exciting, something a little more advanced. I'm going to be discussing one of the ways that I use Bollinger Bands. Many people have heard about Bollinger Bands, and this is a question that we tend to get very often in Cyber Group and elsewhere. People are very perplexed by Bollinger Bands, and yet are fascinated by them. Don't know how they work. Some know how they work, maybe to a basic degree, but I'm going to discuss some more advanced techniques for how they are used. And you can see this chart right over here. I'm showing the US dollar index on the weekly scale. This is a longer term chart that goes back basically 2.5 years. And what a Bollinger Band is, it's an indicator, a technical indicator that uses price as the only input. It basically puts into a formula and draws these envelope lines right around the price. And these lines are basically the second standard deviation line. And I don't want to get into complicated statistics, but the idea here is these envelopes tend to form, or at least as many people think of Bollinger Bands, they tend to form support and resistance levels. That the idea is, let's say, when the currency or asset in question reaches the top of the Bollinger Band, that's usually a sign that the market's overbought and it's likely to pull back. Or when it touches the bottom of it, it's likely to bounce off, and so on and so forth. That's one way of using them. But I actually read the book by John Bollinger, who's the inventor of Bollinger Bands. It's called Bollinger on Bollinger Bands. I love this book. I read it a long time ago, and he explains all different ways of using Bollinger Bands. So I figure, why not start with the master? He's the inventor. Why not see what he has to say about them and the different ways he recommends using them? And of course, I've added my own techniques on top of it all, because it always goes back to confirmation and refining techniques in my mind. So Bollinger Bands, because these bands are basically, they measure the second standard deviation of asset prices. They show volatility. So you'll have a period of consolidation. That goes back to the period, the concept of consolidation that I discussed earlier. Basically, where a market will take a pause and basically go flat and bounce around for a bit before a big move. And what happens is volatility will decrease during that time. And I call that a squeeze. A squeeze, basically, where you see volatility decrease, you'll see those support resistance levels or lines converge together, and that'll usually happen right before a big move. I'm going to show you one of the ways, in addition to looking at consolidation patterns, another way of determining that there's going to be a big move ahead. So you can see these are the Bollinger Bands, and what happens is, during a time of low volatility, where a market or asset is just going nowhere, what happens is traders look away. Whenever there's no action in a certain market, traders will lose interest. And they'll start looking at other markets that are moving currently, higher volatility markets. And that's precisely when the major setup occurs before a big move. It's just when everyone's not looking, that's when the big move's about to happen. So if you want to be a contrarian trader, you want to do the opposite of the crowd, because the crowd is typically wrong, especially at major market turning points. So you want to be looking where no one else is looking, and you want to look away from where everyone is looking, because you want to get in ahead of the crowd. You want to front run the crowd before they start getting in. So what I do is I use Bollinger Bands to look for these squeezes. And what you do is you look for times where the Bollinger Bands actually converge together. You can see sometimes they're really wide. This is a time of high volatility, so the standard deviation lines are much taller. If you measure the difference between the high and the low, they're much wider, and that happens during a strong trend or a volatile move, whether it's slashing up and down or it's just going vertical or straight down. But when they converge together, that's a squeeze. And I say possible squeeze on so-and-so stock in the cyber group. That's what I'm referring to. If I put a Bollinger Band on the stock we're looking at, you would see these bands come together. And these squeezes occur before big moves. And these big moves are known as volatility expansions. So what happens is there are different market cycles. All markets move in cycles. You'll see cycles between consolidation and a rally, or consolidation and a directional move, and so on and so forth. You'll see sometimes markets will bottom at regular intervals, like some people believe in a 7-year cycle. I think it's called a Shemitah cycle. I forgot. I believe it's called that, where every 7 years the market has been known to crash. So the idea is the stock market. 2008 was a crash. Go back 7 years, there was a crash in 2001, and so on and so forth. And it goes all the way back to 1987, and I even think 1929. You look every 7 years, there's basically a market cycle low. So there are cycles in the markets. There's no doubt about that. But the cycles that many people are not familiar with are volatility cycles. And that's what these Bollinger Bands measure. So if you see a squeeze, that typically is indicative that there's going to be a big move ahead. So I'm looking at the US dollar, and this squeeze occurred last summer, summer 2014. I remember this time vividly. I went to visit one of my crude oil trader friends. He owns an energy trading firm, and I went to go visit him and speak to some of the traders, and at that time, they were pretty much despondent because volatility was so low, not just in the currency markets, but all markets. And a lot of these traders make their money and their commissions, if they're brokers, from the volatility. And that's what drives trading volumes. And there was no volatility to be found anywhere. And this was back in June 2014, right before I wrote my oil bust warning. So it was the calm before the storm. So it's interesting to see in real time the psychology that's occurring in each of these types of market cycles. During this time, traders were so bored. Many traders and brokers were getting laid off during this time. I remember certain currency trading desks were laying off brokers and traders, and energy was really suffering. And that was because of that squeeze. And at that time, people thought that the currency markets were just a sleeper. They were like, there's more action going on in the stock market and elsewhere. So the second they looked away, that's when the big move happened. So all of a sudden, the US dollar index started to soar and broke out of that squeeze. And then what happened was the volatility expansion started. And that's when you'll see the upper Bollinger Band will start to turn upward. In the case of a rally, of course, and it's obviously reversed. It's the inverse for a downtrend. And then what happens is the dollar index followed it all the way up. And that's how you know you're in a strong trend, a very powerful trend, when you have the asset actually hugging along that Bollinger Band all the way up. And it did it all the way up, and it's still right near there. And then the other thing you'll see is the lower Bollinger Band turn down. You'll actually see it turn to the downside. So you'll see the top one turn up and the bottom one turn down. And that's how you know that there's about to be a big move. And you'd be able to tell this quite early on, back in as early as late August, and certainly by September, the trend was on. But you were given enough of a heads up that there was going to be a big move by around September. So I'm going to show you some examples of other squeezes right now, just to show you that it doesn't only work on the US dollar index. Let me just get my chart here. I'm going to show you some other instruments, and we're going to look for squeezes. Here we go. This is the Australian dollar. Completely different currency. Look at that wonderful squeeze in August. I wonder... Come on. I mean, that told you there was going to be a big move. Oh yeah, look at this other squeeze in early 2013. Look what happened. Big move. Nah, it's got to be a fluke. Only the US dollar and Australian dollar show those squeezes, right? Nope. You'll see squeezes in all the different markets. You see that happening right here. This is the dollar Canadian. You saw this happen back in 2013. Let me show a market that's pretty uncorrelated. Let me just find some examples. You'll see it in futures. You'll see it in many different markets. Here we go. Crude oil. Right here, 1 year ago, last spring. And that's why my energy trading friend, that's why they were freaking out. They didn't know the future of this business because there was just no volatility. A lot of these traders thought that volatility had pretty much permanently died, and they thought that's because the Fed has now permanently backstopped the financial markets, and it means basically the end to major volatility. Because usually there's volatility when there's fear, some sort of a fear event. When let's say the stock market's rising and traders are euphoric or optimistic, you won't see the kind of volatility that occurs in some sort of a panic. So this oil bust that I warned about was a panic. Same thing with the US dollar index surge. That was a panic. People freaking out. And that's what causes these drastic moves. So you can see oil squeezed. And then once it broke down, it followed the Bollinger Band all the way down. It hugged it all the way down. You can see the upper Bollinger Band turn up all the way down. Let me see some other examples. Just looking at gold. And okay, here we go. Actually, let me show you on weekly. Let me. Here we go. This was gold. I'm just going back a few years when gold was really surging. And you can see this is gold during the bull market, right after the global financial crisis from 2009 to 2011. I personally was trading quite a bit of gold. I made a lot of my income one of those years. I think it was in early 2011 just from trading gold and silver, funny enough. And then I ended up selling it after it declined right around here, because once that happened, I said I was really expecting it to rise above 2,000. Didn't do it. I'm still interested in gold and silver for the longer run, though, but I became suspicious because I was concerned that all commodities prices were going to drop and that it was going to pull gold and silver down with it. I wrote several articles warning about a commodities bubble, and that's exactly what happened. But I'm watching if there's further downside in gold and silver. Once I feel it's finally bottomed or near the bottom, I want to buy a lot of physical precious metals, because I don't trust what central banks are doing with these fiat or paper currencies. You can't just print to oblivion and not expect your currency to weaken. And they're all doing it. All these, Bank of Japan, now the ECB, European Central Bank, printing money, QE program. The U.S. was doing it. Who knows if they'll do it again if there's another panic. So the idea is you're flooding the world with paper. And I think in the longer run, that will benefit precious metals. But I digress. Probably another webinar topic too. But you can see this is gold. It's squeezed in August 2009. That was back when gold was underneath $1,000 an ounce. That was a nice move. It's made since then, obviously. Squeeze. You can see this alternation between low volatility and high volatility. Squeeze, expansion. Squeeze, expansion. So here was the expansion in late 2009, and then volatility died down again. There was a consolidation. And then that was a sign that it was going to be another move, and that's what happened. Now it's up to 1,252. This is in summer of 2010. And then a squeeze, and then another expansion. And then a squeeze, and another expansion, and so on and so forth. So this is a very powerful market concept, but it's one of the many that I'm aware of and that I teach. I don't want you to think I'm giving away the farm, all my secrets. I mean, I know I am a market nerd, and I've been a market nerd since I was 15 years old. But just like to share some of these ideas. So Jeffrey asked me, can Bollinger Bands be used on intraday charts effectively? Absolutely. It really depends on the stock, of course, because some stocks tend to be less tradable than others. I know in the Cyber Group room they use the term tradable. What you want to do is you want to look at a stock that is trading in a very fluid manner, a stock that's not chopping up and down, a stock that is not too thin and illiquid. So, okay, you're talking about Forex. I'll finish this and I'll get into the Forex idea of it. Whatever asset, doesn't matter if you're looking at Forex or stocks, you want them to be trading more fluidly. But the idea is, look to see how Bollinger Bands have worked in the past on that particular asset that you're interested in and on that same time frame. And if it looks like it's behaved well and looks like it's worked well in the past, then I would say I would consider using it. Whereas if it's just too choppy, then I would be skeptical of using it. So what is my setting for the Bollinger Bands? In this case, this is just the standard one that John Bollinger uses, and this is going to be the standard that's on most charting platforms. This is the 20. It uses a 20-period simple moving average, and uses really just the second standard deviation. It's the standard settings that are recommended. I have not played around or really modified it in any way. So I mean, I'm sure there could be settings that are maybe even better adapted for certain markets, and it's worth playing around with if your charting service allows you to do so. But all right, let's take a look. So does this squeeze does this squeeze concept work well on intraday with currencies? Let's take a look. Well, this is the euro versus US dollar, and you can see this is the 5-minute scale. And you can see there was a squeeze right over here. This was just on this is earlier today. I believe this is 6:25 a.m. Eastern, right over here. And you can see it squeezed, it converged, came together. Very often you'll see these squeezes occur before a major news release. So what happens is traders will be sitting on their hands. They don't want to place any big trades. They don't want to make any decisions. And then once the news comes out, that's when you'll see the market will pick a direction, and then it's off to the races, and then you'll have an expansion. Let's look a little bit earlier. There were several squeezes. You can see a squeeze right here. It squeezed a bit. This is 1:50 a.m. earlier today. It was squeezed, and then it had a breakout, but then reverse direction. You always have to use. Sometimes these will reverse, and John Bollinger talks about this in his book. Sometimes you'll have a head fake that'll happen during a squeeze. Sometimes it'll pretend to move in one direction, and then it'll whip and do the other. But once it finally picks that direction, it'll usually make a big move. So you can see drop below, was unable to break. And then maybe you would have taken this trade when it finally broke down, but then maybe you got stopped out, maybe even with a small profit. But once it finally picked its direction and started running to the upside, then you can see this expansion. That was a nice move right there. And you'll see this happen on intraday, all time frames. But some currencies and some time frames work better than others with this. So you want to look in the past, and obviously, usually it'll work better like typically on an hour, because hourly tends to be less. There tends to be less noise, just because it's not as subjected to just randomness. Really, the more specific you go, or the shorter time frame you go, there's going to be more randomness in the market. So here we go. This is Australian dollar, US dollar. This is back on March 18th. I'm looking on the 1 hour chart. You can see there was a squeeze right over here. And what happened? Boom. Big move. Broke out. Lower Bollinger Band moves down. Follows up. I mean, I have many other techniques for actually determining how to trade a squeeze, how to know when a certain threshold has been broken. It's not enough to know that there's a squeeze. You need to really know what's the actual trigger, what's your risk management strategies and tactics, and so on and so forth. But I just thought I'd like to share that one technique with you. And if you liked that technique and you're interested in learning more, I'd like to invite you. I'm teaching a much more extensive class on Friday. It's called the Phase 3 class. Some of you may have taken my Phase 1 and also Phase 2 classes that I taught in the past month or so. But I want to invite you to my Phase 3 class. And I'm going to be teaching you so many different methods for trading Forex, and also that are also applicable for futures and stocks, etc. Let me just get down to this slide. Different techniques that you can use along with risk management, and you're going to be getting a solid education, that you're going to be armed to the teeth to take on the world of Forex and futures. And I'm going to ensure that. And the other courses that I've taught have been extremely popular, great reviews, and I'm constantly developing them and adding more, and I'm very generous with my time as far as Q&A sessions at the end and making sure you really understand these techniques. So I really just put it all out there with a lot of different concepts that you will find valuable. It doesn't matter if you're trading intraday stocks on Cyber Group or you're trading crude oil futures, etc. So I included the link right here in the room. Check it out. It's on Friday. There's 2 lessons. First one's at 10:30 a.m. from 10:30 a.m. to 11:30 a.m. Eastern Time. And then lesson 2 of this Phase 3 is from 3 p.m. to 4 p.m. Again, this is on Friday, March 27th. And it does cost $1,697, but the techniques you're going to learn in here will allow you to make a multiple of that for the rest of your trading career. So you think about the investment that you make in this knowledge is a gift that keeps on giving down the road. So that's the idea. It's like upgrading your mind, your trading brain, so that you can dramatically increase your results over your career as a trader. So it's well worth it when you see what I'm going to teach. So hopefully I'll see you all there. All right, so you folks have any other quick questions you want to discuss? Let me know. I love talking trading. I'm a trading nerd. And I'm going to give you my email address, Jesse at C2 Trading. If you can think of any questions, just shoot a message to me and we'll chat. You know, I love these markets and very passionate about it. So, is there a squeeze on the dollar down? Jamie asks me. Let me see. On what time frame are you referring to? On the dollar, let's look. Oh, you're asking on the shorter time frame? Let's look. See, this is very interesting. I don't know, for those of you who have been following, maybe who were following the Forex world 1 week ago, last Wednesday, that was the big Fed meeting, the FOMC meeting. And you can see, I'm just looking on the 2-hour time frame, but you'll see this on the 1 hour. You'll see this in different... It's good to play around with different time frames to see which currency or which market you're looking at and see how it works best. So in this case, it looks like the 2-hour worked quite well. But you can see there was a squeeze right before that meeting, meaning that's the calm before the storm. And that foreshadowed that big move. That's how you could have told. You wouldn't have even had to have known that there was going to be a big Fed meeting. You just look at the squeeze, and most likely, probably 8 times out of 10, you could say, there's probably a big meeting going on very soon, and you would have been right. And that's what happened. Actually, the dollar, where the U.S. dollar index and the dollar index futures flash crashed here. This was a big algo move that occurred, and there was a lot of news. I don't know if you follow Zero Hedge. It's a very popular trading and finance blog, and they were discussing this occurrence. So, all right, folks. Send me an email if you have any questions, and I hope to see you in my coming class.
Perfect. So
take care. Bye.
Today's Wednesday. We are our weekly trader.